Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of The Options Playbook, and I'll be your host here for about the next 20 minutes here on Options Guide TV. Today we're going to be short and sweet. Right now, today is March 22nd. 2024. The markets are open and they are rocking and rolling. It is 11 a.m. Eastern time. And the markets have just been strong. We made it through another Fed Funds Watch meeting, and the markets took that as a positive note. And the markets have been sitting basically have propelled all the markets across the board to new highs. Some of them new all-time highs. IWM is looking stronger, and we looked at a long call spread going into the meeting in the S&P 500 index. So with our long call spread, here it is inside the options playbook. I'm just going to start here for a second before I go to the TradeHawk software. And our main focal point when we're looking at our long call spreads, when we're doing it as a staple in our portfolio, it's like our one speculative trade that we're talking about week in and week out. We've been kind of switching between skip strike butterflies, long butterflies. We've actually went on the short side and did a calendar spread or a time spread using puts to get bearish on the marketplace. And the long call spread, whenever we're doing this trade, we are selling the most at the money option contract. So envision we're in the S&P 500 index. The market is right around strike B here, and we're selling as much time premium as we can and then going deeper in the money and buying strike A with a lot of intrinsic value, but with also a lot of time value. And that's the way that we set up our trade in the S&P 500 index. And with the market going to all-time highs, that obviously looks like a good trade for the week. I don't even really think there was a moment where we might have done the adjustment. We talked a little bit about it on Wednesday, but we'll review the trade and see where it's at. We talked a lot about how time premium happens by using the actual chain when we were a little bit in the money on the S&P 500 index, and that was right ahead of the Fed meeting and Chairman Powell's comments about the meeting, which I think were more important than the actual announcement of the fact that they were not going to change rates. So let's start by just highlighting the CME FedWatch tool. So what's next? Right now, we have another 40 days before the next Fed funds meeting. We obviously have a lot of economic data before those 40 days, and they always say that their outlook is dependent on the data. So if we scroll down, May, it looks pretty boring right now. The rate right now is 5.25 by 550. They kept it there. And 86% chance based off of the futures that the market will stay there. They're saying there's a 14% chance that they're going to cut it 25 basis points. But it gets real interesting when we go to June. So the futures here are saying that there's a 62% chance that they cut it. Oh, actually, let's go back to that. Interesting. 2550. I actually looked at this wrong. 2550. If we look at the June contract, now they're saying a 62% chance that, oh yeah, it's going to come down. No, I'm right. 2550. So it's going to come down to, there's a 62% chance that they cut it 25 basis points. And then let's add another 10 onto that because they're actually saying there's a 10% chance that they cut it 50 basis points. Now, I don't know if I really believe in that. That's just a speculation bet. I don't foresee that they would cut it 50 basis points at all. So surprised to see that number there. But if you combine these two and you add these together, you're looking at about a 70% chance that they're going to cut in June by looking at the Fed funds futures. And there's only about a 30% chance, or 28.8% to be more accurate, that they keep the rate where it is at. All right, so that's exciting for you Fed watchers out there to see that in June is basically the first cut that they're expecting. And if the markets are correct, or the money is correct is a better way to say it, it looks like it's happening in June. So I'm going to pop back out. And once again, I'm still traveling, so you're looking at my picture instead of my ugly mug. But we're going to run over to the TradeHawk software. And let's look at our long call spread to start with. So we're going to pull up SPX and we have today's expiration. And we know that the trade is good, but I also want to show you that it still takes time for the premium to get out of the S&P 500 index option contracts. It's a tough thing to get the maximum out of our trade. So if I look at my notes here 1 second and I scroll down, our strikes for the S&P 500 index, the market was at 5165. We bought, well, actually, it was 5170. When I took my screenshot, it moved a little bit. We were at 5160 is what we bought in the call options, and the strike that we sold is 5170. So here's the March expiration. That was, we started this on Monday. Here is the date. Just always want to make sure that you have the right, that this matches this, because in option trading, you always want to double check everything. We have to scroll down. We go 5170 is the one that we sold, and 5160 is the one that we bought. So let's buy this one first, and let's sell this one. This is the position we would have on in our account. And if we look down, it's trading for $9 at this point. Well, it's jumping back and forth, $9.95, $10. So you're not going to close it for $10 exactly. And if we look at the extrinsic value, we're 74.90 by 75.60. So don't make a mistake of thinking that you can go in and close out this position at $10, because you're basically saying to a market maker, I'm tired of looking at this trade. I'm going to get $10 for it. Duh, the market's not going to come down, which I'm actually saying that sarcastically, because there's always a chance that anything can happen when it comes to the marketplace. But I just want you to let me out of the trade for the maximum, and I'm not going to give you anything. So if I try to enter this at $10 when it's worth $10, I'm not going to do. I'm not going to make money on that. I can't go to the grocery store and say I want to pay what you paid for that apple, right? So I could give up 5 cents. You might even have to do 10 cents on this trade, but I would start right about here, and I would work the trade down a little bit and maybe see if you could get out for $9.90. Or a wonderful thing about the S&P 500 index is that they are cash settled as opposed to the SPY. The result would be fairly similar in this case because we're so deep in the money, but you don't have to worry about transactions with the buying and the selling of the stock. You would just wake up tomorrow, and for your 1-by-1 spread, you're going to get the 10 points, 10 times 10 times 100 is $1,000. You would see $1,000 less any fees in your account if you just let this ride to expiration. And at this point in time, I would feel very comfortable doing that in my own account. If we had this position in, you didn't get out any time earlier, which you probably should have got out yesterday. I probably went to taking the market risk today after it set a new high yesterday and closed out the trade and had to give up a nickel or a dime, whatever I would have had to do to get out of the trade. So a successful trade. And I'll ask, I mean, do we still want to get bullish on the market? Normally, if we're looking at the SPX, we're going to do the long call spread. We would start that on a Monday and go until a Friday. If we want to do the skip strike butterfly, which is our standard in the S&P 500 index, I don't mind putting that on today. I don't mind doing it on Monday either, today or Monday, if we wanted to do that trade. If we want to get bearish, we would be looking at a calendar spread on the downside. And that is the trade that I think I want to kind of focus on a little bit after talking with Dan Sheridan and Sheridan Options Mentoring. I don't mind doing a butterfly on the downside. That's not a bad way to go. But actually, let's do that. Let's do a butterfly paper trade today, and I'm literally doing this on a whim, and watch the activity. And we're going to do, and the one thing that you do love about the S&P 500 index is today is the 22nd. You come back out and in then on Monday, we have an expiration, which is the 25th. And then on Tuesday, we have an expiration, which is the 26th. And so we can really craft our trade with the daily options, or the zero DTE, some people would call them, in the S&P 500 index. This is a zero DTE option. It means it only lasts for today. So I think we're going to go out and do a real short-term butterfly. Now, this isn't going to be part of our standard portfolio. We might even get long on Monday based off of what we see over the weekend. But we've had such a strong market. Let's have a little bit of fun and learn about some option trading. And we are going to look at a 2-day butterfly. And we'll also look at a 2-day calendar spread. We're going to go about 50 points down from where the market is at, and we're going to look at both of these trades. So I'm going to set them both up. We'll use the Tuesday expiration and see if we get a pullback on Mondays. If the market ever does gap in the S&P 500 index, it usually likes to gap on a Monday to the downside, I should say. If we get a gap to the downside, that's usually happens on a Monday. So just because I didn't really have a trade set up for today, well, I'm going to look at the IWM and see if we want to get long that market yet, which is the Russell 2000 index. But we're at 52.35. So a 1% move to the downside would be around 50 points or so. So if we do that, we're going to go 35, almost 1%, a little bit more, maybe 60 points. Then let's set that butterfly up. Okay, so March 26th, I see the box. I look over here and it says, yes, the 26th. We go, let's go 60 points down. So you're talking 52.35 minus 60. We're looking at a strike right around 51.75. And if we do the calendar, we're just going to do 2 days. We're just going to do the 25th and we're going to do the 26th. So you'll have 1 day for that one option contract to work. If we're doing the butterfly, we're going to do the 26th. So this is going to be an experiment. I wouldn't want to jump into this trade and just run into it, if you will, because once again, I'm just doing this off the cuff. So let's look at the put side of things. So here we are in the options grid on the TradeHawk software. And we're at 51.75. That would be 60 points, about 1% down on the downside. We're looking at buying this option contract, and we're going to go 15 points wide on this one today. So 51.75, we're going to buy this one. We're going to go down 50 points, 51.60. We're going to sell 2 of these. And then we're going to go down another 15 points to 45, and we're going to buy 1 of these. Okay, come on. Shoot, I froze a little bit there. Oh, it won't let me put more than this in because I still got this strike down here. Okay, so let's do this. Doom. Got one more trade, 51.60, and then we're going to go to 45, and there we go. I had too many in the order ticket. You can only put 4 in the order ticket, by the way. That's the most legs you can send to the trading floor. So it stops you at that. So here we are. We're looking at 15 points wide, and we're able to do this trade. Seems too cheap, 45 cents. Maybe it's because we went down farther enough. We're 15 points wide from here. All right. The market's moving. So there's where we're at, 42 cents. $42 to set up this trade 1% down from where that market is at. Wow, where's the VIX at? VIX down to 12 in this instance. All right, let's put this on. This is going to be our paper trade for this week. We're going to look at doing a put butterfly, very short term, hoping we get a little bit of a movement to the downside on Monday. And we're going to buy the 51.75 strike put on the March 26th expiration, sell 2 of the 51.60 strike puts, and then buy our protection at 51.45. We're going to do this for a net debit. Let's call it 50 cents. I like that. Nice round number there. We'll say 50-cent net debit to the account. And that means we're going to spend $50 for every 1x2x1 butterfly that we've done. Okay. So we're going to note that one. And let's go and compare this to a 1-day calendar spread. And we'll clear this out. And we're going to look at the 51.60. That's still the target on the downside. We're going to take the March expiration, which is Monday. And we are going to buy on the call on the put side of things. So the 160s. So here in this instance, we're looking at buying this, selling this option contract because that's the March expiration. And then we're going to run over to the 26th, make sure that we're in the same expiration. We're going to look at the 160 strike, and we're going to buy that one. So we sold that one. We're going to buy this one. All right. So in this instance, it's a little bit more expensive. We're looking at a net debit of about 50 cents to put on this trade. It's a little bit different dynamic. And we'll throw this into the what if calculator. All right. And let's scroll down and zoom in. So the what if calculator looks a little different, but if you've ever looked at a profit and loss graph for a butterfly, you got a lot harder lines. There's a lot more movement in the what if calculator here in this profit and loss scenario. So we want the market to come from 52 all the way down to 51.60. About a 1% move is going to be right around the 75 area, right in this range. And if we land somewhere in here, in this range, about from where we're crossing at expiration, we're crossing, or at the first expiration Monday, 51.30 right here, and this is 51.92. So the difference between the calendar, which we're going to highlight up here, and the butterfly is going to have 2 days to live. The calendar, we're looking to get out on Monday. We could stay and ride the trade to Tuesday, but we would just be long a put from Monday overnight going into Tuesday. So we're going to look at both of these trades. This one's going to cost us a little bit more to do the trade, but we have a different dynamic in that we're really looking at the March 25th expiration, and we're going to be buying that one option contract that's right here on the put side of things, paying 70 cents for that trade, or receiving 70 cents for that trade. And then if we go to the March 26th contract, we are looking at $1.85. But this is really a 1-day trade, and the SPX is a 2-day trade. All right. Any questions that you have on what we're looking to do this week? Oh, I do see Wayne. All right, Wayne, we have a question. Let's go and throw that in. Hey, Brian, if we did an SPX 0DTE short iron condor, and wanted to increase our premium collected, would you widen the width of the strike or increase the number of contracts? Well, you could do a little of both. Okay, so obviously, if you increase the number of contracts, Wayne, you're going to be adding premium to your iron condor. And you are saying with the iron condor that you're selling the put spread and selling the call spread. So if I widen the widths of the strike, I'm taking on more risk to do that iron condor. And because I'm taking on more risk, I can put together more premium. So, in theory, Wayne, if you do two contracts, right? Let's say you do two iron condors and your width of your strikes, the maximum loss, let's say, is 10 points wide. If you do two that are 10 points wide versus doing one that is 20 points wide, the premium should be similar by doing the trade that way. You have the same amount of risk, but one of the biggest things is that your maximum risk kicks in sooner on the 10-point widespread. So there will be a little bit of a trade-off because of that. And I don't have a great answer for you as to, do I want to do a wider spread versus doing two contracts, because it's not an apples to apples comparison on the trade, right? They're not synthetically the same, because where your risk kicks in, it is different. So either of them are okay. Looking at it both ways, it's okay to place either of the trades if you are hoping that the market will stay neutral within a certain range. The big thing is that if you double the contracts as opposed to going wider, your maximum risk will be reached sooner. So you would want to be paid accordingly for that, right? You want to receive more by doing two iron condors in that scenario than by doing one iron condor and making the width double on the strikes. But that's a great question, Wayne, and I really appreciate that. I think I kind of summarized that. We got a few minutes. We could kind of look at it. Well, I'm going to keep these trades in here, and let's go to March. And I sent that to the what if calculator, so I remember where that's at, because I'm going to have to grab the screenshots when we get done here. Okay, so we're going to go one standard deviation out, 5180 and 5190 here. So on the put side of things, we would be selling this one, buying that one. 10 points wide. Let's go about one standard deviation out. It doesn't matter that it's exact. We're at about 16 here. We're going to be selling the call spread and buying that one. All right. 190 is where we're at. So let me jot that down. 190 is what our price would be. Obviously, if we doubled that, let's call it $2, and then if you double it, we're looking at $4. That's the premium that you're going to bring in. But $2 is where this is at. Now, if we, wrong side, shoot. 195. Our protection is going to be 5,300. Buy. There we go. I finally got it right. So now it's 275 net credit. Double that would be 550. If we ended up doing two of these. So 275 net credit, 550 if we do two of them, and then we would have 10 points of risk. Make sure I didn't screw it up down here. And that's 80 points, and this is 80 points. Yep, everything's looking good. Now, if we change this up and we change our wings, so we got to get rid of our buys. We get rid of this one, get rid of this one. Now, 5,300. This would be 5,310, and this is our buy. And we go down here, and we are short this one, so we double this up. We go down here, boom. Okay, so as I mentioned, it's close, Wayne. It's close, right? We said 5. Well, I don't know about close. Close is, I guess, relative, whatever you're looking at. it would have been around 550 to do two of them, but your risk is going to kick in 10 points sooner versus going wider. And now you're looking at 460 net credit as opposed to a 550 net credit. So it all comes down to where is your risk tolerance. On the other trade, it's going to go, you're going to be looking at the risk kicking in at 5170 and at 5300, and you get a little bit more for that. So it's really up to you. It's really that. So this was the scenario. This is exactly the way your question played out. And I got a little long-winded on it, but I think it's straightforward. There's not a better solution. There's just trade-offs, which is usually the case with all option trading. All right. I said I'm going to look at IWM. Let's pull up the chart in IWM. And we're going to leave it here. We're coming to the end of the half hour. I told you I was going to be short and sweet to get today, but I was not, I guess. And we mentioned we really wanted to come down to, well, let's redo that. We wanted to come down. On the marketplace, we wanted to get down to this range, kind of where we we came close to 199.67. My buy point would have been somewhere around the 200-day moving average. If you go all the way back to this day, that would have been right around last time we did it was 197.50. And by did it, I mean we bought a long straddle. So we really didn't get down within that range, and we've already moved back up. I would have liked to have seen it come back down. Even the 50-day moving average would have been something interesting to look at. I still want to get long the IWM. I'm trying to figure out where that entry point is, or do a long straddle. This is just looking off of this high way back here at 198.65. That was an interesting area. Last long straddle that we did, we were, I think, right in this range, right around 197. It did pay out, but it came back right away. So we had the strong move up and then a pull back. Now, if anything, I just want to get long the IWM, and I'm trying to find a good entry point. I'd probably wait till next week. We said that last week that we might wait to this week. We didn't really get down to a nice solid range where right in here where you wouldn't mind getting long, because it's all about the fact that it came down, went back up, back down, and tested. This would have been the third time that it would have came back and tested the top of this channel. And I just think that would be an interesting time to speculate in the IWM. You could also just, in anticipation of interest rates coming down, IWM isn't a bad way to play that. And just buying the IWM to get long if you think the economy will stay strong and that rate cut is actually coming. Rate cuts usually help small caps, makes money cheaper for them. All right. That's it for this edition of Options Guide TV. We will come back on Monday. And honestly, I'm very curious to see how our two paper trades work out. It is a test scenario. A lot of times we look at these trades and our more serious trades, like when we got the long call spread in the SPX this week, that was a standard trade that we've been looking at for months and months and months since Options Guide TV originally kicked off. This trade is pure speculation. So we're doing this for education. We're gonna look at how these option contracts react on a very short-term basis over the weekend. Thanks for coming, everyone. See you this Monday. Please click subscribe, ring the bell if you are on the Tradier YouTube, and we'll have a new trade for you in the SPX on Monday, and also we'll look at our paper trading portfolio. Good thing we rolled the Google position. Let me mention that. Let me run back over here. We did move that Google position because now it's at 152.26, up real strong today. I'll probably have to roll the Google position again, and we just rolled it. So lucky that we did it when we did, but there's still time premium in it. So we're at the 150 strike on our short call. We're going to probably have to roll out to the 154 strike probably. All right. Thanks for coming, everyone.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and/or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and/or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc., all rights reserved, member FINRA SIPC.